Hey everybody, Jason here today, and I wanted to take advantage of a snow day and President's Day, a day off, so we might as well extract some value out of this day instead of sitting around watching Netflix and guessing what's going to happen tomorrow when the market's actually open. I've actually been wanting to do this particular video for a while. If we start understanding the very fundamentals and the very basics together, we can build
double calendar spreads, calls, our puts to our spreads, iron condors, butterflies.
From our puts to our calls, detective put strategies, our Christmas tree spread with Christmas lights, Christmas tree calls, colors, our iron butterflies, broken wing butterflies, you name it, we can build it.
There's a strategy for just about anything. But if we don't have a good understanding of the fundamentals, we can't really understand what we're going to do with all these and the different ways to put them together. One of the core things that I do, of course, are put credit spreads. So the main thing that I'm looking at is extrinsic value, and I'm looking for that to decay. So I wanted to take a closer look at value, intrinsic and extrinsic. So this is a quote from Aristotle about value. And it's basically about why is water, the basis of life, something everybody needs? Why does it not hold very much value compared to diamonds, which, yes, they're shiny, but as something for survival or something that you need, why are those valued so high when water, it can't be exchanged for anything? It's an interesting thing to think about, how we place value on a lot of things that don't necessarily have value. The whole diamond story is actually more interesting, way past Aristotle, but if you look at how value skyrocketed and why your wife, girlfriend, or fiance wants a diamond, that's a really great story. But we'll skip that for now, and there's some great documentaries about it. So what is value? Value is what someone is willing to pay for something right now. Right this moment, not in the future, right now. So actual value can be determined a number of ways. Just to put some interesting perspective on it. So at home, you have a choice between a gallon of water and a big fat diamond, and you only have $100. Which one are you going to choose? And you could buy either one of them. Obviously, you're going to buy the big fat diamond. Now put yourself in another situation. You're in the middle of the desert. You're just about to die of thirst, and you have 10 grand. Now you have the same choice. You want to take your 10 grand and you want to buy a big fat diamond, or you want to buy a gallon of water. All of a sudden, the value of the water is super high, right? The other things that are interesting, name brands are very interesting to me. This is a lanyard I bought. I only have one key. I have a garage door opener built into my car. Essentially, my phone is the key for my car. So this is it. So this lanyard is pretty valuable to me to keep track of this key, because without the key, I wouldn't be able to get in and out of my front door should the power go out, or if I just leave for a walk and I need to get back in after I lock things up. Now what does it do to it when they slapped a name brand on it? Does this become more valuable now? Would you pay more for it? I've got this jacket. I actually quite like this jacket a lot. I especially like it right now. So we just got 7 inches of snow outside. It's been 28, 29, 32 degrees for quite a while. Now, question is, a couple things. So this jacket, you go find it at the store. Maybe it's, I think I found something very similar for probably $30, $20 or something at the store before. But then I wanted one from Tesla just because I love Tesla. Does it make the value any higher? Well, I paid more for it. I wanted it and I was willing to pay a certain amount. Tesla was willing to sell it for a certain amount and we met in the middle. That was agreed upon value. Valuable at that time. If I was stuck outside, if I was literally locked outside and I had nowhere to go, that jacket may be worth 3 or 4 times the amount. That's part of the situation component of value, is your exact situation. So in a desert, water is going to be worth more than all the cash in the world. It's going to be worth more than diamonds. In the freezing cold, a nice warm jacket is going to be worth more than money that you have. Be better off giving away anything that you consider wealth for warmth and survival, right? The intrinsic value is always going to be the agreed on price right now. When we look at a chart, for example, just a stock chart, the best example of this is when it's forming a wedge and you have people on the bottom. They're pretty much stopping that bottom from happening because they think it's worth more than the price. That's why they're willing to buy it. And the people at the top of a candle or a wedge, they think it's worth less than that. So they're selling, and that's why you'll see a wedge forming as people agree and get closer and closer to this agreed upon price. But it's always what it is right now. So you have a classic car, you feel like the value is $5,000, you put it out for sale, you get 7 offers, and the highest is $3,500. That means the value is $3,500 right now. Maybe in the future it'll be more, no matter, and it doesn't matter how much you think it's worth. It's always the maximum somebody is willing to pay, and then the minimum you're willing to sell it for. So it has to be agreed upon price for a transaction to take place anyways. As it relates to options, the intrinsic value is always what that option can be exercised for. A call only has intrinsic value above a strike price, meaning the stock price has to be above the strike price. Because if you exercised that call for 100 and the stock price is 120, that means right now you could collect the difference between those two. And a put is just the opposite. So it's only going to have intrinsic value when the stock price is below the strike price. Somebody agreed to buy it for a certain amount, in this case 100. So in this case it's a $100 strike. $80 is the price of the stock, which means you can go out to the market, you can buy them for $80 a piece, and then you can turn right around and sell them to somebody else for $100. So you make that $20, which times 100 shares is $2,000. Those are the only 2 times where you have intrinsic value. Only one exception, if the stock is just about to have a dividend payment. So somebody could see, let's say, the stock is 5 cents below a strike price and it's about to go ex-dividend, or the date that you need to own it by in order to collect a dividend. That dividend would typically be added onto the price. So if there is a 40-cent dividend, the stock is 20 cents below it, it would effectively be worth 40 cents more. This is a reason that a lot of people will not recommend trading right around dividend times, or ex-dividend specifically. Also the reason that you'll see a stock typically go up right before ex-dividend and then drop right after. Extrinsic value is basically everything else as it relates to the value of an option. But this is the potential or the future value. So in our case with our water, the current value may not be very much. I don't know what we pay for a gallon of water. Let's say it's $1. And then all of a sudden you bring it to the desert. Now it becomes more valuable. Depending on where it is, things can have higher value. So if you think about going to like a theme park, like Disneyland, outside of Disneyland, you may be able to buy a water for 25 cents, soda for 25 cents, 50 cents, food for relatively cheap. As soon as you get in those gates where you don't have any other options, all of a sudden those values go up. Water's worth more. Everything inside of there is worth more. A warm jacket is worth more to me outside in the snow. With options, all of the extrinsic value is going to be time and volatility. So when a stock is below a call price, the only thing it has is extrinsic value. It has no intrinsic value at that time. Like, you could not exercise it and gain money. When something does have intrinsic value and it still has time available, it has both intrinsic and extrinsic value because there's still time, and then volatility is always going to be a component of it up until the very last second. So put only has extrinsic value above the current stock price, meaning there's no intrinsic value yet. The strike price is 100, your stock price is currently 120, there's no intrinsic value. Everything there is extrinsic at that point, because right now you could not exercise it and it be valuable at all. As far as extrinsic and intrinsic value goes, hopefully you understand the intrinsic portion, and we'll talk about how to calculate that in a little bit. But the extrinsic value is going to be your time plus volatility. So first, let's look at the volatility. Let's look at the volatility of a couple stocks that we should know. Gamestop and GM. So unless you've been, I don't know where you would have to be to hide from what GameStop has done over the last few weeks. So just looking at this and not looking at what the actual volatility numbers are, we can visually see how volatile these things are. And it may not be very apparent right now, but if you actually look at the low 52 and the high 500, that's a 10x right there compared to a 47 and a 57. Now on the next slide, I took the GM portion and I squeezed it down so it's basically so the vertical scales are going to match one another. You might find this interesting if you haven't seen this. So that is what the two look like. So when we squeeze that down, we can really see that this really hasn't moved at all, and that's in relation to GameStop. Obviously, GameStop, I wanted to take extreme examples so we could see extreme differences, but this without going into a calculation of volatility, which if you want to, you can definitely look that up. It has to do with the average price over a given time, and we'll look at the formula for that a little bit later. If you're buying options on a specific stock, you should know enough about it to know whether or not it's very volatile. All things being equal, we can take something that is very similar price. This is GameStop closing at 52.90 and GM 53.69. So it was the closest two stocks I could find with almost opposite ends of the spectrum as far as volatility. So if you look over here at the GameStop, these are both expiring March 19th, right? And on our GameStop, an $80 call is $735 compared to our GM, that same call, same time. So we have, in this case, no intrinsic value because the call is above the current price of the stock. We have the exact same time component, so the only difference here is the volatility. So quite a bit more. So this isn't the normal range of things that you would see, but on a low volatility stock like GM, relatively low, it's not the lowest, compared to a maximum volatility stock like GameStop, this is what you're going to expect to see. But of course, everything else is probably going to end up somewhere in between these guys. And the volatility on GameStop, we could never see it again. I won't say never, but we'll probably likely never see that continued volatility. I'm actually kind of surprised it still has this much. And then so now we see what the volatility component looks like on an option. Now we can take a look at the time component. So these are two more examples. So this is March, April, and July. Can I mark these up? Nope. So this is March, April, and July, the same $80 calls. So same volatility. Now we have the same stock, same volatility, and the only thing changing here is time. So we have the 735, 1148 in April, giving us, that's another month. So we're basically paying another $4 for time, and then to go all the way out to July, paying another $5 on top of that for some change. These are the only three things that you will pay for with an option. You're going to pay for its intrinsic value if there is any. These $80 calls have none. You're going to pay for time, and you're going to pay for volatility. So that first one, intrinsic value, how are we going to calculate that? Let's take a look at it. This is actually pretty simple. So a $42 strike price, we had to go below the current strike price in order to see any intrinsic value at all, because above it, it doesn't have any. This is, if we exercised it right now, it's basically the difference in the strike price and the current cost. That is our intrinsic value right now. In this case, it is, here's our stock price, and we subtracted the 42 strike price because that's what a call allows us to do. It allows us to buy it for that much, which gives us $10.90 or $1,090. That's our current intrinsic value of this option. Everything else is extrinsic value for this option. So when we look at it, what we're paying for this particular option, and we're talking about the 42 right over here, We're paying $24.05. We just calculated what our intrinsic value is of 1090. So this right here is our extrinsic value. So that $13.50, that's what we are paying for number one, time, and number two, volatility. You just put those two together and you're basically saying, I'm buying time for this to move, time for this to pop off, to drop, to do whatever it's going to do. And if you notice, this $13.50 plus our actual price of our stock, that equals this break-even price. Break-even always refers to on the date this thing is expiring. So in this case, July 16th, that means there's no more time left, one component, and volatility is no longer a factor because once it's expired, it no longer can move, right? So there's no possible value from either of those two things. And that's why when we talk about theta decay, that's the stuff that is actually going to drop off fairly rapidly as you approach that point. Because as you get closer and closer to that expiration date, of course you have less time, but you also have, within that time, you have less time for this thing to move. Now that we've calculated intrinsic value, we know what that is, we know what the components of extrinsic value are, but how do we calculate extrinsic value besides knowing what that number is to actually figure out how that one is made? Here's the calculation. Good luck, you have fun. This is the actual calculation. I don't think it is valuable at all to know this. Just know that you're paying for time and volatility. That is all. That is the only thing above the intrinsic value that you're paying for an option. The further and further you get along with your understanding, the less important that some of these fundamentals become. You're automatically going to recognize what's going on with what you're buying. You can very quickly look at an option price and know how much or where you want it to move. Also know that volatility will affect an option price right away, and it'll affect it in both directions. So you can see a stock drop and then the call gains value as well, which doesn't seem right because it's moving farther and farther away from having any intrinsic value. But the volatility component is so huge at that point that it actually can push it up in price. So know right after a move, you're going to see more volatility. Once it's stagnant, you're going to see less volatility. Some of the best case scenarios is buying a call on a low volatility stock and then it rising up unexpectedly. So no earnings coming up. Nobody was expecting a big move. But because all those options, like in the example of the GM call, nobody expects it to rip up there. Then all of a sudden you have this, then all of a sudden the volatility component of the option has risen more than was expected. So your return is going to be better than buying an option with the underlying with a low expectation for it to move, because it's kind of like a surprise. So I hope this is helpful on some level. If you guys stuck around for this long, thank you so much. Thank you so much for watching the whole video. Thank you guys for the comments. I super appreciate them. If you guys have any questions, let me know below and I'll try to answer them. I want to take these very basics, and I did this because I feel like these very basics are kind of skipped over quite a bit, and then I want to build from here, and we'll take a look at some more specific calls, puts, and then put them together to form different strategies. Thanks again for watching. Love you guys. Now go and make a lot of money.